Debbie Marcoux is licensed by the Department of Financial Protection and Innovation. Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 20802379926, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
All right, so welcome to Mortgage Mom Radio. I am Debbie Marcoux. I am the Mortgage Mom, and once a week I come to you guys live and give you all of the information that is going on in the mortgage and real estate world. Of course, today was a big Federal Reserve meeting. People were anticipating that they were going to talk about possibly rate cuts. So we are going to get into that today. We're going to talk about what happened, what did they say, and what does that mean for what is coming in the future. How did it affect interest rates? What are we seeing right now in our rate sheets? So it is going to be a great show. I do invite everybody to put your questions into the feed, get interactive with me, and I will read those out loud and answer them for you. I can see that Annette has jumped on, so thank you so much, Annette. She says happy Wednesday, and happy Wednesday to you as well. So once again, I am Debbie Marcoux. I am the Mortgage Mom, and we are live. So let's start off. This is today about the Federal Reserve. What did they come out and say? And I really feel that the best way to start these shows is to actually read to you what was the statement, the press release from the Federal Reserve. So I'm going to read that. It's going to take me about 60 seconds. It's not a very long one today. And then we're going to dive right into, kind of interpreting it and what does it mean? And really the big thing is what happened today with our rates, what is going on with our mortgage-backed securities and our bonds. So press release was at 2 p.m. Eastern Standard Time today. It says recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have moderated and the unemployment rate has moved up but remains low. Inflation has eased over the past year but remains somewhat elevated. In recent months, there has been some further progress towards the committee's 2% inflation objective. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee judges that the risks to achieving its employment and inflation goals continues to move into better balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 5.25% to 5.5%. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. In addition, the committee will continue reducing its holdings of Treasuries securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. So that was basically their statement today. I can see that Nicholas jumped on and said hello. So I'm going to jump right into this. We're going to interpret what they said. But again, I do want to remind everybody that this is interactive. So tell me hi, give me a thumbs up. But even more importantly, ask your questions. I am more than willing to read them out loud and answer them for you. This is a show that I want you guys to get something from. I want that to be every week. And I want to make sure that I am educating you and that you are learning. So what exactly are they talking about in this statement? It actually sounds very, very similar to all of the statements that we have read since July of 2023. That was the last time that they actually increased rates or made any changes at all to that Federal Reserve prime rate. So we have been holding steady now for 12 solid months. We have not seen anything change in 12 months. Now, what we did take from this, number one, is that the economic outlook is uncertain and the committee is attentive to the risks to both sides of its dual mandate. So what are they saying in that sentence? It's a very important sentence in their statement that they released today. What they're saying is that they are watching very, very closely to make sure that keeping interest rates elevated are not going to, in turn, start to throw us into a recession. And during his, he always does, after they release the statement, he always does a press conference. And during that press conference, that was something that was very, very much talked about, was that it is very important to them that we don't start to move into that recession stance. And so they are watching all of the indicating factors, all of the reports that are coming out. Today, we did see, retail sales come out, not very good. We saw unemployment did tick up a bit. And so all of those signs are starting to move towards, if we stay high for too long, they absolutely could throw us into that recession. So many, many analysts, the majority of analysts right now, are still believing that we are headed towards a rate cut. They do believe we're going to see that first rate cut in September and then a second rate cut in November. However, I have been saying here on my show as the mortgage mom, and I've been saying it for probably 19 months, maybe going on 20 now. So if you guys go back and watch later shows or earlier shows, or I guess past shows, that's the word I was looking for. If you look at my past shows, you will hear me say it over and over again. I think that we're going to see our first rate cut come in November. But many analysts believe that we're going to see that come in September. So I have fingers crossed. I would love to see that happen. I would jump for joy if I am absolutely wrong and it does come earlier than November. But there were many people that were starting to get really worried and very concerned that they were completely taking rate cuts for the year of 2024 off the table. That is how many were feeling when in May and June, when inflation was coming in higher than anticipated and it didn't get lower than the previous report released. And so I don't believe that we've got a rate cut completely off the table. I truly don't. I 100% would gamble and put my money on the fact that we will see a rate cut this year. I believe that it will be November. And I am praying with fingers crossed and hoping that I am absolutely wrong and that we see that rate cut actually come in September. So that would be really awesome if we do. I can see that Ashley jumps on, says hello from Henderson. So Ashley, thank you for joining. Appreciate it. And Heidi jumps on and says, hi, miss ya. So we miss you too, Heidi. Hope everything is going good. So I do want to talk a little bit. I've kind of given you the press conference and what they said, and we've talked now about the fact that, things are kind of status quo. They changed absolutely nothing today. They are not changing any of their stance whatsoever. They're truly trying to get us down to that 2% level. It's very important to them. We are seeing indicating factors, as I mentioned, in all of the reports that are coming out. The last inflation report came out better than expected, just by a hair. Unemployment, like I said today, came in a tick up, so it was a little bit worse than anticipated. So all of those factors are there that are moving towards the fact that we're going to see these rate cuts come. And so what does that mean for you as the consumer? So today we actually got a really nice rally with the bonds and with mortgage-backed securities. We're actually seeing our best levels yet in about a year, if not longer than a year. And the rates are looking good. So for example, if you have an FHA loan or a VA loan and you took a loan over the last 18 months, I would say probably within the last 18 months, the interest rate that you have on your loan is definitely higher than where you could be refinancing today. So this is the first time I've actually been able to say this in over 2 years now, that somebody has an opportunity to refinance, not to pull out cash. That's a different situation when we're trying to consolidate debt and we're trying to pull out money for home improvements and such. That's a totally different situation. That depends on what do you owe, who do you owe it to, how much do you need in cash, what are you trying to improve, how much do you need for those improvements. Totally different scenario. But today is the first day that I can actually say that we are at a point where you could refinance a rate and term, just refinancing a streamlined refinance of your current mortgage balance if you have a current VA or FHA loan. So I do want to get into those as well. Those are called our interest rate reduction loans. And what does that mean to you? But many of you, that interest rate could have dropped at least 0.5%. We can't do those loans unless we see 0.5% improvement in your interest rate, but that is something where we are starting to see these opportunities are coming. Conventional loans, guys, if you've got a Fannie Mae or a Freddie Mac loan, we are definitely in a position where we are far better than where we were a year ago. So again, those are loans that you want to call, you want to reach out, and you want to see if it is something that we can do to improve your interest rate and your monthly cash flow. So we are getting there, and it was very exciting to see those interest rates get better. Aurelio jumps on. He says, hi, Debbie. So Aurelio, thank you for jumping on and for watching the show. And I love that everybody's commenting and saying hi. And again, if you guys have questions, please let me know. I do want to talk a little bit, though, about why are interest rates getting better even though they left the interest rate where they did. So why did we get a nice improvement today even though the Federal Reserve came out and said we're not going to cut interest rates? So I'm going to explain that here in a minute, and then we're going to talk about what we foresee over the next couple of months as well. So don't go anywhere. 60-second commercial so I can grab some water, and we'll be right back.
She's the mortgage mom.
This is Debbie Marcoux, the mortgage mom. Well, I've had a lot of questions lately. What can I do to bring my monthly payment down until interest rates get better? Well, if you are a buyer and you're out looking at homes, what you want to focus on is a program called a 2-1 buy down. If the market rate today is 7%, you would start your first year at 5%, year 2 at 6%, and year 3 through 30 would be at that 7%. It's a great way to enter the market today, knowing that rate cuts are just around the corner. Give us a call or head on over to our website at mortgagemomradio.com.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926.
When you're in need and don't know where to go, pick up the phone and call mom.
Okay, so welcome back to Mortgage Mom Radio. I am Debbie Marcoux. I am the Mortgage Mom, and today we are talking about the Federal Reserve and what they said and what does that mean to you. So right before that quick commercial break, I said I was going to talk about why interest rates would have gotten so much better today if they said that they weren't changing or they weren't cutting, they weren't bringing that rate down right away. So it's actually what everybody anticipated and expected. So nobody expected it. A couple of analysts expected it to maybe possibly, do a rate cut today. But the majority were not expecting that. They were expecting them to say we're going to hold them steady. Interest rates for mortgages are very much the same as what you get with the stock market. One day they're up, one day they're down. They're not directly connected to that Federal Reserve prime rate. I know that I have said that before, but this is a great way to explain it so that you can actually see no rate cut today, interest rates improving. So they improve based on information and data that is coming out, news that is coming out, big articles and things that are, blowing up the industry. And that changes the interest rates. It changes the mortgage-backed securities, the desires and wants of the investors to buy into them, the sales of them, the bonds, 10-year notes and 5-year notes, 2-year notes, right? It changes all of that based on anticipation. Everything it goes into just like the market, just like a stock would be up one day and news comes out or somebody says something. Look at what happened to Netflix just this past week. Just one big thing can make a huge change in what we see. So they also build into the interest rates what they're expecting. So the majority of investors were expecting that rates were going to remain the same today, which they did. With that anticipation and with that expectation, they were already building into our interest rate sheets the fact that it wasn't going to change and that it wasn't going to, they weren't going to cut that rate. So when they came out and they actually announced that that was the plan and that was what they were doing, then that actually just, it was a driving force behind more people jumping on board and, buying of the mortgage-backed securities and those 10-year bonds and 2-year bonds. It's helping our rate sheet because what is expected is what happened. Now, if they would have come out and said that they were going to cut the interest rate every single person out there would think that would have actually made interest rates better. And it very well could have. But I have been a veteran. I am a veteran in this industry. I've been doing this now for 30 years. And I can tell you that many, many times in the past, we have had rate cuts where we've actually seen interest rates go up. And we've actually seen rate improvements where they've cut the rate, rate increases where they've actually increased the rate. And we've seen our interest rates drop. So it is very, very much a market. Our interest rates and our rate sheets are very much a market that is driven by expectation. So the fact that what everybody expected to happen today is what happened, that is driving our interest rates to be better. So that is actually really great news. Now, the other thing that is going on is that because they held steady and that was the anticipation and expectation, they're also mentioning in that Federal Reserve press conference that they did, they would not say when they would do a rate cut. They would not indicate. The Federal Reserve Chairman Jerome Powell has been very much the same throughout every single press conference that he has been doing since they initially started hiking those interest rates back in 2022. I believe it was the beginning of 22. It could have been the end of 21. But he has been very, very much straight-laced as far as not giving any indicating factor of a yes or a no at the next meeting. However, many of the analysts that were reporting back, and you guys can Google it and start to research it and read up on it, but many of them are actually feeling that he was quite dovish in his comments, and that to them is actually indicating that we could see that rate cut come September. So there's just a lot of anticipation around the fact that we are getting there. What needs to happen is happening. We're cooling off as an economy, and that our chances of having possibly 2 rate cuts, but for sure, no matter what, 1 rate cut this year is coming to fruition. So those are the things that are moving the markets. I can see Lyndon jumped on and says, hello, hi, Debbie. We are looking to take out money for home remodeling, about $125,000, but we do have a low mortgage. In a second, has a much higher interest rate. So I think he's saying he wants to take out $125,000, but he's got a very low interest rate right now on his first mortgage, and that he knows that interest rates on seconds, so home equity lines of credit and home equity loans, do have high interest rates. And that is absolutely 100% accurate. Equity lines right now are running anywhere. They are 100% based on your credit score and your loan to value. So how much money do you want to take out? What do you owe on your first mortgage currently? And what is your home worth? So your loan to value, that drives that interest rate along with your credit score. So I have seen interest rates recently for home equity lines that we have put together that are starting at 9.375, and I've seen them as high as 13, almost 14%. So again, a huge driving factor is that credit score and how much money are you trying to take out in relativity to what your home is worth. Now, one thing that I can tell you is that the majority of the time when someone calls me, just got a call yesterday from a previous client, so I'll give you that scenario. She needed about $150,000 to pay off some debt, pay for some college tuition, and also replace a roof. So she had multiple reasons why she needed her money. So $150,000 she needed. When we looked at doing a refinance with cash out, her current interest rate was at 4.5%. She's got a $520,000 mortgage. So $520,000 of her money is at an interest rate of 4.5% today. She needs $150,000. $150,000 is not, that's a third maybe, and I'm sitting here, in studio, so I don't have a calculator in front of me. That's maybe a third of what her balance of her mortgage is, right? So if we take that entire amount, that $150,000 and that $520,000, and we put all of that in an interest rate, let's call it, 6.5%, right? If we did a refinance today, 6.875, whatever that number might be. And yes, you guys are hearing that. We are out of the sevens, which is great. But when we do that, her monthly payment goes up significantly. So let's just say we went to 6.5 as an example. That is a 6.5% interest rate on all of that money. If I did a line of credit for her at 12%, now mind you, again, she needed to pay off debt and all of her credit cards are pretty much maxed out. So her credit score was on the lower side. So her interest rate for $150,000 was at 12%. When I take that 520 at 4.5, and I take that 150 at 12, her combined blended interest rate that she's paying on that overall debt was actually at 5.95%. So it was less expensive interest-wise for her to have the two separate loans. It will improve her credit scores immediately. Within 30 days, as soon as she pays all of her debt off, she will see her credit score go through the roof. We both had the conversation that interest rates are improving. We're in a position that they are improving, that over the next 6 to 12 months, we should see interest rates get significantly better. And she'll have a fantastic opportunity to be able to roll those two loans together into one loan. So refinance to consolidate those two loans within the next 6 to 12 months. So she decided she wanted to move forward with that line of credit at that interest rate of 12%. Now, I just recently closed a line of credit for a client that had a 760 credit score. We did a loan of $400,000. He had a ton of equity. His home was worth quite a bit of money. And that interest rate came in at 9.5%, which was significantly less expensive than trying to refinance the $1 million loan that they currently have on their home at an interest rate that was below 4. I believe they were at 3.75%. And then putting, an additional $400,000 on that balance in that 6% range. So every single person is significantly different. I had another client that their blended rate, when we did that work together, their blended rate came in at about 6%. They were able to do a refinance at 6.5%. And for them, it was way, way more comfortable that they had a 30-year fixed interest rate. that they had one mortgage payment, and down the road when interest rates dropped, that they could do a rate and term refinance and lower that interest rate even further. So everybody has a different reason why they do what they do, and every single person benefits in a different way. But yes, to your point, Lyndon, interest rates are high on second mortgages, whether it's an equity line or a home equity loan, but they can very much be beneficial. They can pay off debt, they can increase credit scores, they can get home improvement done. When that home improvement is completed, that home's value is more than likely going to go up as well. And it does help to open up opportunity for a complete refinance down the road. So if there's something that you've been thinking about doing, like you said, you need about $125,000 for your roof and for your kitchen, it very well may be worth your time to pick up the phone and give us a call and talk to us, talk to me, talk to Heather, and see what those opportunities and those options are. So I hope I helped. I hope I answered that. And I invite everybody to keep putting those questions into the feed. I will not leave this show until I get every single question answered. So Annette did say, is this a good time to sell our house and buy a new one considering the interest rates? So that is a great question. Here is the thing. When you are selling a home, the biggest question to you would be, is your goal to go and buy another home? So if you are going to sell the home, take the cash out of your home, and then you're going to go buy another, I don't typically worry about whether you should wait to sell because homes might be worth more in the future, or you should maybe wait to sell because home values might be less in the future. So I want to throw that right now completely off the table. We're going to talk interest rates. And the reason for that is that you're taking what you're selling for and you're buying from the same market to the selling from one market to the same market in the purchase, right? So whether you sell higher and buy higher, or you sell lower and buy lower, that's kind of a wash, right? So let's talk about those interest rates. Should you do it right now because of rates? So if you are concerned about the fact that you might have an interest rate that, let's say, in the 3 or 4% range, and if you were to go and buy a new home today, you would end up at a higher interest rate, there are solutions for that. So I've talked many times on the show here very recently about our 2-year buy down program. So what that does, there's a 1-year buy down, a 2-year buy down, and a 3-year buy down. So it depends on what you can negotiate with the seller that you are purchasing from to get them to pay in closing costs. But the 2-1 buy down seems to be the most popular. And so what that does is, let's just say, for example, interest rates today are at 6.5%. And again, I'm just throwing a number out there to give an example. I am not quoting a rate and I'm not promising a rate. Okay, guys. So it could be lower, it could be higher. I'm just throwing out a rate just to give an example. And that's a pretty average rate for today. So a 6.5% interest rate today, if you did a 2-year buy down, you could actually start that interest rate for the first year at 4.5%, second year at 5.5%, third year at 6.5%. So what that does is it gives you that lower start rate for the next 12 months. In all reality, over the next 12 months, we will see interest rates come down. You will have the opportunity to refinance. Can I give you a number that they will come down to? No, nobody's got a crystal ball. I can't tell you where in exactly a year from now interest rates will be, but I can tell you that they will be lower than where they are today. You will have that opportunity to refinance, to get into a 30-year straight refinance of a lower interest rate. So the 2-1 buy down gives you the opportunity of 4.5 for the first year, 5.5 for the second year. So that gives you 24 months at interest rates that are lower than where today's market rates are, allowing you that time frame for the market to adjust on its own and to be able to refinance to get into a better interest rate permanently. Now, one thing about the buy down that I do want to make sure that I'm very clear about is that it is a 30-year fixed rate. So I have had people that have come at me and said, well, I don't want an adjustable. And I said, it's not an adjustable. It is a 30-year fixed rate program. Highest interest rate that you could have on that program for years 27 and remaining would be the market rate. So in this example, we're talking about 6.5%. So it does give you that reassurance that it can't get any worse than what you see. It is all disclosed to you, so you know what a worst case scenario payment would be. It's not an adjustable that it's going to all of the sudden change on you and your payment's going to go up by $800 a month. You are going to know right out the gates from day one of taking that loan what your worst case scenario is. But that is a fabulous option right now in the environment that we are in, where we are seeing interest rates are coming down. They're coming down slowly. Once we start seeing rate cuts, we're going to see them come down a little bit faster, and it gives you the opportunity to make that move. So there are a lot of people, many people out there that over the last 2 or 3 years have been needing to make moves. You know, their kids are moving out. They are ready to downsize. They're ready to retire. They've got kids. They had bought a 1 or a 2 bedroom condo and they've really run out of space. They've had another baby. Just normal things that happen, in life have been not happening. So if that makes sense. So most people on their normal changes, sell the house, list it for sale, buy a new one. People have been putting those goals on hold because the house that they're in, the interest rate that they have is so much less expensive than what they could get if they were to make a move to a new home, that they've decided to put that on hold and to wait. And this is why we've seen lower inventory, higher prices, right? So we're going to start seeing with this 2-1 buy down will help you to make those moves that you need. And as interest rates start to come down, we're going to also start to see more inventory come to market. I think we're going to start seeing everything normalize. We're going to see more homes listed for sale. Your house is going to stay on the market a little bit longer than what it used to. So be prepared for probably 60 to 90 days before you get an offer on your home. So the longer that you wait to put the home on the market, the more homes that will be available for sale and the longer it will take you to get the home sold, but you will get it sold. So I know I went in a million different directions with that. The answer is yes, you could sell today. Yes, you could buy again today. And if you have your plans on hold, maybe reach out to us, give us a call, let's talk, and let's see if we could figure out a way to make it something that you could do now instead of just continuing to remain on hold. So again, I know I went in a million different directions, but it's all things that you guys need to be thinking about when you're trying to decide, should I sell now? Should I wait? Should I refinance right now? Should I buy right now? These are all really, big factors in today's economy that you guys need to be aware of. So Michael Manriquez just gave me a smiley face. So cool, man. Love to see you here. I love it when you join. Nance424 says, do you recommend any program that will help with deposit or closing costs? Do you have any knowledge about NACA, which is the NACA program? So Nance, I'm going to be totally 100% honest with you. You can only be so good at so many different loans and different programs. I am not an expert at NACA by any means. I do know what it is. It is a fabulous program. And I would suggest that you do, if you are a first-time buyer, I would suggest that you go to their website and you read up on the program. It will give you all of the information of what you need to fall within their guidelines to be approved for that program. So start off by figuring out if you're eligible. And then if you are eligible, on their website, it will have a list of approved lenders for their program that you can reach out to and utilize. So being 100% honest, and that's what I love about this show, and I'll always give it to you guys straight, NACA is not something that I have dabbled in, and I would choose to not ever make a client coming to me be my first client ever working with a particular program and make them be my guinea pig. So I would suggest that you find somebody that's an expert at it. The thing to keep in mind with all of the down payment assistance programs is that there are eligibility requirements that are very, very important that you fall within. So make sure that you read up on it and that you're eligible for it, and then definitely reach out to somebody if you feel that that would be your best program opportunity. So Lyndon gives me the thumbs up. Thank you. I will call you, and I love that. So I do want to remind everybody, guys, give me a call. We'd love to help. We want to give you that one-on-one consultation. We want to make sure that we're getting you going in the right direction, no matter what the lending is that you need. I just recently closed a reverse mortgage. We have been doing a ton of these new home equity lines of credit that I've talked about a couple of weeks back. They are a 5-day close. On average, they're closing in about 7. It's very quick to get your money. Very easy is the application. It's an automated appraisal. It is an automated employment verification. So they're going to connect bank accounts to see deposits coming in. They're going to automatically show you what you are approved for by utilizing a soft credit pull. And then if you choose to accept the offer, then that is when they'd actually do a hard credit pull. But those have been going over very, very well. We've started to utilize those for people that are maybe going to sell their home, but they don't want to be contingent when they go to buy the next. So we're pulling money out of their home. And then what they'll do, obviously, when they sell their home is they'll pay it off. We've also been utilizing it to pay off debt. So if you're finding that you are starting to get maxed out on your credit cards, which many people are today, getting to that point of maxed out, it is a way to pay off that debt to boost and increase your credit score. And then we turn around and we do the financing for the new purchase or to do a refinance or whatever it might be. So definitely that home equity line of credit has been phenomenal. So reach out if you have questions about that. And also those streamlined refinances. So if you have an FHA loan or you have a VA loan currently in place, and you took that loan over the last 18 months, maybe even 2 years, there is a very, very good chance that we could refinance you today, saving you 0.5% in your interest rate, which can make a pretty significant difference depending on your current loan balance in what that monthly payment would be, and helping you also to get a little bit more cash flow. So with that, I do not see any other questions that are coming in. I invite everybody to reach out. I invite you guys to subscribe to my channel, opt yourself in to make sure that you know when I go live. So you can text the word mom to 844-935-3634, or you can text the word live, LIVE, to 844-935-3634. It does it. Either word works and gets you guys opted in to get a text message from me once a week. But subscribe to the YouTube channel, and that will also tell you when I go live so that you can jump on and we can keep educating you and you can keep learning. That is the exact same telephone number to call my office if you need any help whatsoever with any lending. If you are thinking about real estate, buying, selling, getting a loan of any kind, think about mom. Think about Mortgage Mom. So give us a call. It's 844-935-3634, or go to my website. Go to mortgagemomradio.com. And really quick, I can see that Michelle jumped on. I did promise that I would answer every question. So Michelle did jump on and said I had a question. So I must have missed it, and I did. I'm so sorry, Michelle. So let's read it. She says, I have a similar question. Should I take out a home equity loan just because I have lots of equity, not necessarily because I need the money? So that's actually a great question. And a lot of people would tell you that it might be a good idea to do that, just to have that as a backup. One thing that I can tell you, being a veteran, like I mentioned earlier in the show, and having been in this industry now for 30 years, and I'm sure you guys can start seeing the 30 years wear and tear going on my face. I can tell you that home equity lines of credit, the banks that are offering those lines of credit, when property values start to drop, and many people that lived through 2007, 2008, 2009, who had home equity lines of credit prior to that they had opened when their homes were worth more money, they experience this as well. So go to somebody that lived through that had an issue and talk to them. When you have a line of credit and property values drop, that bank will actually reduce the amount of line of credit that is available to you. So what would be available to you at that time when you might need to utilize that money would be the same amount that would be available to you at that time if you just applied and set up that line of credit at that point. Knowing that if property values were to drop, because that's really kind of where you're at with that question. So should I take out a line right now while my home is worth more money before property values drop, if they're going to drop? So one thing to keep in mind is that when property values drop, that is typically an indicator of recession. And during those times of recession, we will typically see them try to motivate the economy by lowering interest rates. So we usually see mortgage interest rates drop quite a bit during those times to help people to afford, to kind of stimulate the market, right? So why would you take out a home equity line of credit today that could possibly be reduced when your home value was to drop, and take it out today at higher interest rates than where they might be later? So I would absolutely tell you, Michelle, obviously, if you want to, I'm never going to turn anybody down, and I'm never going to not do a loan that somebody asks me to do. So if you feel wholeheartedly that it's important to do that today, I will help you. But if I were giving you my recommendation and you don't need the money and there's no reason to have it other than you just think you might be able to get a bigger line today than what you might get tomorrow, I would wait until you absolutely need it, and then I would apply for it at that time, because that same money that they write today is not going to be available to you tomorrow. So I hope that did help. Michael says, is it wise to do an appraisal on your home after you have done a significant remodel? So I mean, not really. Appraisals are really done for financing, or they're done for a reason, right? So you're going through a divorce and you guys are splitting assets and you need to value that asset for that divorce proceeding. If you are, again, trying to get a loan, obviously you're always going to have one done. If somebody passes away, a lot of times to settle the estate, an appraisal might be required. You could get an appraisal done if it's just something that you're just, curious to know what your home is worth today with those improvements that you completed. But you could very easily also reach out to a very educated real estate agent who could do a market analysis for you, a competitive market analysis. And that would actually be for free. And they're going to come in very, very close to what the cost of an appraisal and an appraiser would be. So I don't necessarily think that you need to throw the money out unless there's a reason for it. So, do you need that appraisal for insurance reasons? Are you trying to go to your insurance company and say, my home is worth more, I need to increase the amount of coverage that I have, and you need an appraisal for that. So unless there's something specific that you need to spend, $600, $700, sometimes more, depending on what your home's value and the size of your home is. If you don't really need to spend the money, it's just a curiosity thing, I would call a really good real estate agent. And if you need the name of a real estate agent where you live, in your area that is good there, you're more than welcome to reach out to us, and we'd be happy to point you in the direction of somebody that can help you. Those agents are always going to be willing to do it, and do it at no cost. Show you what the most recent closings in your neighborhood have been. Did the house next door or the house down the road that recently closed have the improvements that you had? So that could be something that you could do, and that is absolutely free. So again, feel free to reach out. And if maybe there's a particular situation that you're asking me about that I didn't happen to hit in this answer, please feel free to, like I said, reach out to me. You guys can all reach out to me directly. You can go to my website and you can click contact us. That sends me an email and it comes directly to me. So I'm going to answer that question. You can email me. I'll just give you the direct email. It's really easy. It's Debbie, Debbie, at mortgagemomradio.com. So you can absolutely email me directly. And you guys can always call our office. You're always welcome to call. So it's 844-935-3634. That's 844 We Lend For You. WELEND and the number 4. So Michelle says, thank you. And you are very, very welcome. She says, is the interest rate on a HELOC variable or fixed? So home equity loans are always fixed. Home equity lines, it depends on who you get your home equity line of credit from. Some banks will offer an introductory fixed interest rate for the first couple of years. Other banks don't offer it at all, and it is adjustable right out the gate. The home equity line of credit that we have recently introduced that I talked a little bit earlier on the show about, that loan is actually fixed for the entire 30-year term that you keep that money open. So there are different opportunities available, and it's based on the bank that you go to. And let's see, Michelle says, do we need to update the home insurance after we've improved the home with new windows, new roof, solar installation? I just want to increase my premium. I don't want to increase my premium, just want to know, is it obligatory to report? So you don't necessarily have to report it, but if you don't report it and your policy isn't written for enough to cover a rebuild should it burn down, then you wouldn't, then you're putting yourself in a position where you're going to be underinsured. So I always recommend reaching out to your insurance agent, having the conversation, letting them know what you've done, asking if you have enough coverage on the policy the way that it stands. If they feel that it's something that you do need to increase your policy, obviously, if you increase your coverage, your premium will go up. But it is really important to make sure that you are not underinsured. You definitely don't want to be underinsured. Something happens and you cannot get the cash that you need to rebuild. That's going to be an absolute tragedy. So, it absolutely doesn't hurt to call your agent. And just because you call your agent doesn't mean that they have to change your policy. You can call and you can talk to your agent and explain what you've done and ask if, they feel that your coverages are sufficient, and you guys can have that conversation before you decide to make any corrections or changes. So Michael says, thank you. And Michael, you are very, very welcome. I hope that I answered that question for you. And again, guys, I promised that I would not get off this show today until I answered every single question. So I hope that you guys saw that I was wrapping it up, and then I stopped and I came back and I kept answering. So I'm not seeing any additional questions come into the feed. So I can see that my dad jumped on and said hi. So Dad, good to see you. And I am going to start to wrap up the show again now, but if another question comes in before I've wrapped up, I will stop and I will answer it. But if I don't, here we go. We're wrapping up today. It is Wednesday. We started a little late today. I started at 1:30 to know when I go live to make sure that you do not miss it. Text the word live, LIVE, to 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. Now, I do want to explain really, really quick the difference between the mom text code and the live text code. So once a month-ish, I will send a message out to my mom code. The mom code has every single person that has subscribed to mom and has subscribed to live. But I will send out a message about once a month letting you know that I went live to the mom code. Then on a weekly basis, I send out the notification that I'm going live to my live code. So the live code is people who have most recently, over the last 3 or 4 months, subscribed to know when I go live. I am trying very hard to not bother people. My mom code has been around now for about 5 years. So somebody that might have opted in 5 years ago may not be interested in watching my live show today. So I'm trying to not overwhelm anybody, and it's been around for so long that I don't want to be texting people that are not necessarily interested. So if you know that you texted the word mom, you've gotten a text message from me maybe the last couple of weeks, but then there was a good period of time in between, you got no text message at all, then you are on my mom code. So if you want to get that text message every single week, make sure that you opt yourself in to the live code. So one more time, text the word live, LIVE, if you want a weekly notification. And it's 844-935-3634. That's 844-WE-LEND-FOR-YOU. WELEND and the number 4. I don't see any more questions, so I'm going to wrap it up. I hope you guys have a fabulous rest of your week, and I'll be right back here again next Wednesday, somewhere between 1 and 1:30. We'll talk to y'all real soon. Bye-bye.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's a mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.